Hello and welcome to this week's Gig Harbor Market Update, and it's brought to you by coffee. Hold on, wait a minute, I gotta get some more. As I was saying, coffee. Anyway, let's get into it. First thing I want to cover, local, is that Seven Seas is back open, finally giving Tides Tavern a little bit of competition. It was down for renovation, and here I can show you, I took a picture for this thumbnail, but let's see what the architect drew up here. This is Ferguson Architects in Tacoma. They are the ones responsible for the design, so if you love it or hate it, you can tell them directly. Anyway, they do a lot of stuff, commercial. I think I missed it here. 1 second. Boom, scrolling. Here we go. Seven Seas Waterfront Tap Room. Kind of just a brief overview. 6,000 square foot, and you kind of get this cool axonometric view of it, kind of the rendering, what it's supposed to look like, and I'm sure they're going to populate it with professional photography here soon once they get those back. But that's who's responsible. I know the architects usually don't take a lot of credit, but for some reason contractors love to take all the credit. So anyway, that's who did it. A little PSA for local news. Anyway, let's get into, I guess, another local thing, which is Matthew Gardner, who is Windermere's chief economist, and he released his little Monday with Matthew. I want to go through it. It is what it is. I'm going to go through it rather quickly, and I will talk about what I think the low inventory really means for our market. All right, let's get into the first graphic here. This is basically showing how much inventory there is in the U.S., and the orange line is the month's supply So this is our inventory levels. So basically, how long it would take for all the houses to be sold if not a single house came on the market. So currently this year we were around a little bit over 3 months of inventory. As you can see, that's pretty low, but still higher than 2021. And the bar chart is basically the amount of inventory there is in the U.S. So this is in, we're currently a little bit over 1 million, according to this data, which is interesting because I have other data, but both cite the NAR. I'll get into that later. But here, just take away, it's about, let's say, 1.1 million houses of listings this year. All right, this next one is location matters. So not all areas are created equal. The only city that has more listings than it did in 2019, so this is 4 years ago, so this time 4 years ago, is Austin, Texas. Everywhere else is below 4 years ago in inventory levels. However, compared to last year, not all cities are the same. So this, I don't know if you can see the dark gray line here at the zero level going vertically is the zero line, so everything to the right, so all the cities on the right actually have more inventory than they did last year, and that ranges from 20% to over 120%, so kind of a smorgasbord of data here. And then here to the left, these are cities or metro areas that have less than they did this time last year. So not a lot less, they don't have the range that the positive side does. So the maximum is like 30% less than last year. But so what I take away from this is basically we're still lower than we were 4 years ago, but a year over year change is kind of it's a hard indicator to tell where we are right now. So yeah, 100 largest metro. Okay, so basically he's saying that inventory levels in 53 of the 100 largest metropolitan areas were down more than 50% compared to the same period 3 years ago. Not sure where they get 3 years ago. 2019 is 4 years ago, so it should be 4. Anyway. Okay, I think he was getting at here is that the lack of resale housing is good for new construction. And this is the new construction market trends. Basically what we see here is after the crash, new construction has really taken over. I think he says historically new construction makes up roughly 10% of active listings, and we can see that now it's fluctuating between 35 and 30% of new listings. So that's showing that just how much existing houses are coming on the market right now, so resale houses. So a lot of the new construction is actually making up for a good portion of new listings. Historically, this is where he's talking about the price differential between new construction and existing homes. So a new home is going to have a premium on it because it is a new product. It's like a used car versus an old car. So here we can see that new homes on average are $455,000 versus an existing home is just shy of 400. Those prices would be great here, but they're sadly new homes around here probably $1 million plus. So that's anyway. But during COVID, we did have new construction at the same price of existing homes, just because of the things that were going on with the cost of construction and all the things that kind of happened back then. But we've started to see now this divergence again, where new homes are commanding a more of a premium. So the premium average 16%. So yeah, back in June it was a mere $1,000 difference between new construction and existing homes. So you get a lot more bang for your buck buying an existing home, assuming it's a good quality home, which many of them around here are not, especially in Harbor Hill. Sorry if you live in Harbor Hill, but those homes are garbage, even though they cost at least $800,000 to $900,000. All right, the last thing is that builders can issue their own financing, which makes it very attractive for people who can't afford an 8% or a 7% mortgage. They're saying, hey, you can come in here, get a 3% interest for the first year, 4% in the next year, and then it goes up to 5% for the remaining of the 5% interest for the remainder of the 30-year terms. So this is a very attractive offer. That major players like D.R. Horton can offer. The home that I'm building, I won't be able to offer something like this. Just it needs to be sold. I can't sell or finance it. But this is just something that major builders can get away with, and attracting a lot of buyers away from, or the fact that buyers don't have a lot of options, and so they say, oh well, new construction, even though it has a premium, it's still cheaper if I get a lower mortgage rate. So that's just an interesting tidbit. So let me just read Matthew Gardner's bottom line here. It says, the new home industry will continue to take an outsized share of the market for the remaining of 2023 and likely most of 2024. That said, once the market starts to normalize, I expect them to pull back these incentive programs, making them more likely to start raising prices as well. Although it's pleasing to see more homes being built, I still believe that the country will be running a housing deficit when it comes to meeting demographic demand, and this will continue to hurt first-time buyers who will be continued to be priced out of the market. So that wraps up Matthew Gardner's little spiel here. So let me talk about what I think. The first thing I wanted to look at was the discrepancy in the data. So maybe both data sets are right. I don't know. Again, this is from the Fed, so I don't know if I trust their data more than whatever Windermere put together. But here it says our current, as of August, listing count was 670,000 listings. Now, of course, this goes back to just 2016, but in those prior years, we can see, before COVID, that we were at 1.3, let's say 1.2 million listings. So we're about, let's say, half of the normal amount of listings. And that kind of begs the question when it comes to supply and demand. What happens when supply goes back up to normal? Because what we just went through was not normal, but you can see that despite this, we have kind of a trend line that is going to be probably ticking up slowly here as we go back to a normal market condition. So once we double the amount of listings, what happens to price? And I'm not quite sure yet, but let's just go through some more data and to look at what's the probabilities of more housing supply coming online. I think there are three major buckets that will eventually boost supply. And the first bucket is just this trend graph. When 8% mortgage rates become the new normal, people get used to it, this will just continually increase until we hit kind of this magical 1.2 million number. I think it could take 3, 4, 5 years, but it will happen regardless. And that's without any of the other buckets. So that's bucket number one, is just things will, water will seek its own level, right? So this is, listings will seek their own levels. The next one I want to talk about, which is This Wall Street Journal article goes over, but it's going over for the wrong reasons that we're going to talk about. But in this, they just mentioned how many homes are owned by America's largest landlords. So, for instance, here it says, Invitation, which owns about 83,000 houses, has been selling properties that have appreciated to the point that they're yielding less than 4% and putting the proceeds in the bank where the cash is earning more than 5%. And this is the tenants and toilets versus a risk-free treasury yield. So why keep your money in a house with maintenance and risk involved versus selling it, getting out while there's low supply, and parking that money into a safe place like a treasury where it's liquid and can be used at any other time you find, or they find, that they can get more money than that 5%. And here we go. This is a nice little graph where rental home gross yields. These are basically the cities that pay either higher or less than a risk-free treasury. So we can see San Francisco, Los Angeles, San Diego, Salt Lake, Seattle, Raleigh, Nashville, all pay less than holding a treasury. So all those houses are eventually gonna say, well, it's not worth the risk to deal with tenants and property management fees and everything. We're just gonna get rid of them and put them in a treasury. However, some of these other cities where they're paying 7.5% on rental home gross yields, they'll probably keep those houses a bit longer. But as that starts to whittle down, we can see all that supply coming on the market as holding a house is just a stupid move when it's losing you money versus holding it in a risk-free. So, do I want to talk? Let's see. Well, we can talk about it now. That's fine. All right, before that, let's just say that these mega landlords in the U.S. own 600,000 homes in America. So those are all things that are essentially seen as nothing different than a stock or a bond, and it's something easily, bought and sold without a moment's notice. And that's really it. I mean, they're just seen as an investment vehicles, right? So there's no emotional attachment. So if they don't pay enough, then they're going to be gotten rid of. And some of these landlords are really holding on and banking to the fact that rents are inevitably going to catch up. Here we see that AMH's Singlin estimates that this company's rents, which is averaged $2,063 a month, could rise at more than 30% before they reach the cost of buying comparable houses. So a lot of these mega landlords are expecting rents to catch up to housing prices because housing prices have risen so fast because, houses can be bought and sold versus renters can really only be gotten rid of every year. So it takes about a year. So rents really take a while to catch up to housing prices just because of it's a lagging effect. So a lot of these landlords are saying, well, if rents get up to, another 30%, it might be worth to hold these homes. But if it turns out that rents aren't really catching up, what are they going to do? So let's look at what would happen if that, or what are the odds of really rents going up, and can Americans afford that? I just saw this. I should just read it. The reality is the rental rate increases, as aggressive as they've been, have not kept up with home price appreciation. Okay. Now, back to U.S. economy. So this one, it's not quite the whole article I want to show. It's really just about the headline. But Nike, Urban Outfitters, Foot Locker are downgraded. It's about student loans, and that's Jeffries. So they got from a buy to now a hold. Basically, student debt or student loans. The repayments are now scheduled to start again next month. And they're assuming, or Jeffries is assuming, that all this disposable income that has been used towards apparel and other goods going out and all this, there's a graph about it. Let me see if I can find the graph real quick. All right, here I found the the graphs here. Let's see if I can open them anew. So, in which categories do you plan to spend less as a result of student loan payments for starting? We got apparel, accessories, restaurants, footwear, beauty, travel, furniture and decor, electronics, home improvement, groceries, and other. So those are where the spending cuts are going to take place for a lot of millennials here, as average student loan is $400 a month. So that's going to impact the economy. I don't think that is going to be aiding asking for higher rents. Yes, you can ask for higher, but if you have higher vacancy, that makes you bring down your rents. So that's that's basically, trying to squeeze blood from a rock here. Another one I wanted to quickly talk about, because it's made headlines recently, is the amount of outstanding credit card balances that we have. We've surpassed $1 trillion. So you can see what's happened. It's just taken off, and it's not because people are, the economy's super hot. It's because people can't pay off their credit card debts because they're using their credit card to buy groceries and they can't pay off the credit cards. So, it's the economy isn't doing as well as the media pundits like to make you believe. I just don't see wages even catching up with inflation. And we can look here on this Bankrate article. Wages are finally rising faster than inflation. Will Americans ever feel like it? And here we can see the inflation, official inflation. In the pink here, you can see how it's outpaced wage growth. And this is where we are now. And this is where they're estimating we will end up. And probably in the start of 2025, we'll have broken even in terms of inflation and wage growth. And that's assuming we don't have any other catastrophic inflation events in the future. I know all the media pundits are saying, hey, we're gonna have a soft landing. We're just gonna have interest rates slowly come down. Oh man, this sounds so stuffy. Excuse me. Interest rates are gonna come down. It's gonna be a soft landing. It's gonna be baby smooth or buttery smooth. It's just gonna be and then everyone's gonna rejoice, and everybody's gonna have so much money. Well, that doesn't happen. And finally, the Wall Street Journal actually wrote an article about interest rates. This Wall Street Journal article finally does something different, and they actually admit that there's not going to be a smooth landing. This is one of the few publications that actually says so, because if you say it out loud, you are expecting the economy to crash, and we don't want a lot of bears here, especially when election is so close. So, a year from now. But people don't like to rock the boat. But here, the Wall Street Journal says when rates drop, they usually plunge. The Fed thinks different. A lot of people think, smooth landing. We're going to just taper down with the rates. Houses are going to become magically affordable again for some reason, and everyone will be fully employed in everything. However, that is usually not the Fed's plan. The plan fights inflation by creating unemployment, which hasn't happened yet. So anyway, let's look at the Fed funds target rate. So this is different than mortgage rate, but it's basically mortgage rate is based off this plus risk premium. But here we see historically what the Fed funds rate has done. It drops like a rock every time they drop inflation. So you can see there's usually a gray line here that matches with a drop of Fed funds rate. So what does a gray line mean? That means recession, which means higher unemployment, and everything goes along with that. They're finally admitting that when rates get cut, they're going to cut because the government is kind of like saying, oh shit, we broke something. And the government's going to start printing money, and the Fed is going to say, well, let's lower interest rates to spur the economy on. And, well, what does printing money do? Well, we just found out that it creates a lot of inflation, and I wouldn't be surprised if this inflation means that this inflation is not ever going to catch up in quite a while. So, but all these articles are linked in my email. You're welcome to subscribe to my email. Just send me, visit my website. And then, what's the last thing I want to talk about? I think it is the third bucket. Third bucket. And that is short-term rentals. So a lot of states and cities are trying to get rid of short-term rentals because, first of all, they're competing with their hotel industry, which is bad news, but they're also creating shortages in housing supply because they're not long-term rentals. The cities love long-term rentals, however, short-term rentals, not so much. For whatever reason you have, they don't like them. So even Gig Harbor slowly starting to piece things together by doing the little studies and stuff. So it is coming local. But yeah, this is New York. Okay, fine. But let's go through how many. So basically, New York wants to get rid of these Airbnbs, and it turns out a lot of these people that are running Airbnbs do so because they can't afford their mortgage otherwise. And so what happens when you can't afford your mortgage? You sell, even though, yes, you now have to get rid of your low interest rate. But for just, I mean, there's been a lot going on with this, but when we talk about how many Airbnbs are in New York just alone, in New York, I believe New York City, it's higher than 40,000. I think it's just shy of 50,000 Airbnbs. And so that's just something to consider, is there are a lot of buckets here. So, you know, not one is going to trigger everything, but, you know, a little bit of A, a little bit of B, a little bit of C, and all of a sudden our inventory is going back up. And once that happens, I think prices will tend to, you know, come down a little bit. I mean, we have combined with inflation and price, nominal price and real price, I think we can come down probably 40%. That's not saying, oh, this house is selling for $1 million, it's gonna be selling for $600,000 next year. That's not how it works. Basically, it can go down to, like, say, 800,000, and that would be its 40%, just because of inflation taking away purchasing power and the value of the house, and then also, and just the fact that if there's a lot more supply, you know, in 3 years' time, that could trigger more competition between the sellers to find a buyer, especially when buyers can't afford a lot of houses. So that's just some things to think about. Again, nothing here is going to be immediate. It's just things that are kind of, you know, everything's kind of coming together here in terms of kind of a less than rosy economy, and you know, more, I don't know. What can inventory rates do from now? I mean, even the Redfin CEO said we've hit rock bottom, and it's going to be quite a while before we have a normal market again. So that was just, I think, today. So anyway, I'm not the only one that thinks at least a little about this, and hopefully it gives you something to chew about, so you have kind of multiple points of view from my own personal point of view, and then also from other people's point of view. So anyway, with that, thank you for watching all the way through this video, and I'll see you next week.